You have been in the markets from 25 years. What all major differences you have seen in the markets?
Investor behavior change has been spectacular to observe. I've seen so many of these equity market cycles, right? We saw, for example, dot-com crash, early 2000s, right? Then we saw global financial crisis, big drawdowns, each of those cases. We saw COVID, right? All of these had pretty large market corrections.
If a person who is invested already, what are the signs where he should be exiting that mutual fund or like ETFs or anything?
This is very hard, where returns have been quite minimal. The markets are not going to wait for you. Because will you get the dip? Will you invest when the dip actually happens? During global financial crisis, midcaps fell about 75%. In India, there is nothing called value. But growth first, valuation next.
Do you think the sector rotation can be one key point where we can generate alpha from that?
Absolutely.
Hello everyone, welcome to the Hans podcast. Today with us we have Mr. R. Shivakumar, who is the CIO at Axis Mutual Fund. He has over 25 years of market experience, and in this podcast we'll talk about large caps, small caps, and how investing works in general. Thank you so much, sir, for doing this with us.
Thank you. I'm very happy to be here.
Sir, I want to know where all this started. You have been in the markets from 25 years. So what was the point? When did you think about coming to the markets? Where did it all start?
So this is all I've done. Out of college, into mutual fund, and now for nearly 28 years, that's all I've done. I started in this business at a time when industry was still very, very small. This is back in 1998. And interestingly enough, as an equities analyst, then progressed into fixed income. And over the last more than 25 years, I think I've done almost every role in the AMC business. And in a long way, roundabout way of back to where I started as a CIO and heading investments at Axis. So long journey, but started it, and I expect my career will end also with Indian mutual funds. It's the only thing I know how to do.
So when you were in college, did you think about that you want to do this in the long term? Was that the goal?
No. To be fair, think about it, right? This is when I was in B school, 96 to 98. The concept of mutual funds still didn't really exist in anybody's mind, right? I knew I was good at understanding investments. I did really well in the courses on investments. These were early days of understanding things like futures and options, and even financial statements. Back in those days, right? We didn't have the kind of databases. You couldn't go to any online database and download companies' financials. You had to go and find the data. You had some databases, but imperfect. What I realized back in college as well as later is that I had a little bit of a flair for that kind of work in terms of financial statement analysis, going and finding the data, making that kind of correlations as to what makes stocks and in general markets tick. The second thing which I really, really enjoy in this business is that this is the business of trust, where people at large are giving us money to manage. With certain investment objectives in their mind, and that is something which we should deliver on. So for me, that is a very large aspect of my life, meaning in the sense of the fact that there are millions of people out there whose money we are managing is humbling, and I think that's what drives me every day. What can we do better with people's money?
And you recently became the CIO at Axis Mutual Fund. So how's that going?
So I'm an old hand here. I've been with Axis since we started. In fact, from before we got our SEBI license or the SEBI registration for the mutual fund since 2009. So for me, it is where I've been the longest. For most of my career in Axis, I was heading fixed income. So in that sense, I've been a very integral part of the investment team at Axis for a long period of time. I think the CIO position just expands that role to a large extent and brings in more additional responsibilities, more asset classes, and therefore, it's different, but it is what I do. It is what I've done all my life, and so I see this as quite a bit of an additional responsibility, but I don't think it changes the way I am. I hope I can continue, doing what I do best, which is just driving strong performance, and that's what we will really be aiming for.
So in this podcast, we usually talk about like investing, large caps and all that. We'll talk about that. But at the same time, we'll also talk about human behavior towards markets. What do people think about mutual funds and SIP when they invest, or when they even want to redeem also? what's their psychology. But before that, there's one question which we ask to a lot of people, that what's the change you have seen? You have spent over 25 years now in the markets, or like all these phases, what all major differences you have seen in the markets, that okay, this has happened, and maybe a regime change or something like that.
Investor behavior change has been spectacular to observe. I've seen so many of these equity market cycles, right? We saw, for example, dot-com crash, 2001, 2000, to the peak of the 2000, early 2000s, right? Then we saw global financial crisis, big drawdowns, each of those cases. We saw COVID, right? All of these had pretty large market corrections. And if you go back in time, through this entire period, and you see those pockets of time when markets have corrected a lot, you have always seen redemptions. Meaning, if you look at the data on mutual fund industry flows, for example, in early part of 2009 or late 2008, absolute bottom of the market, when ideally you should have been buying, you see net redemptions. And this is a common factor across all the cycles that we've seen in the past. Post-COVID, there's been a significant change in behavior. And we actually see every time market falls, that there is actually more buying. And this is, I think, a very significant change in investor behavior in India. I think it is absolutely commendable for the entire investing public. I think we've, and I'm happy that as an industry, we've driven some of that change. But it is that if the markets didn't work, then people will not trust the markets, right? So I think there is that two-way relationship, right? Where as people like asset managers like us try to communicate that you need to invest for the long term, etc. But the fact that people also trust that and are staying invested. Last couple of months, when you've seen the third Gulf War kind of situation break out, and we saw significant volatility, right? Again, two sharp observations. One is we have seen new gross flows into industry go up very significantly, which means people are using this volatility to buy rather than to sell. And the redemption rate in the industry has dropped. Therefore, the net flows to the industry has been extraordinarily strong in the last couple of months. This again, I think, shows sign of maturity, that people are using these kind of volatile periods where there's correction in the markets to buy into the markets rather than to exit.
People are buying the dip, finally.
Yeah, and it's not much of a dip really now, but yes, people are using this opportunity. Whoever has been sitting on the sidelines or maybe not fully invested are using this opportunity to buy. You can say the same about fund managers also. I think fund managers have also started deploying cash, whatever they had in this environment. Yeah.
So there's one thing which I've seen whenever like market falls, say 2, 3, 5%, a lot of people are now doing lump sum also.
Yeah.
Like if Nifty falls, say 1%, do a lump sum. So do you have that data where you can tell how many people are doing lump sum and how many are doing SIP, something like that?
Yeah, the industry data comes out every month and you can see what is the new sales, new SIP sales. There's a lot of, therefore you can subtract and figure out what the lump sum. So like I said, there is some evidence to suggest that even those lump sum sales have increased. Now, can I time that and say when in March or April that happened? Did it happen exactly at the bottom? Or that's not possible for us to say, right? Because that data is not available. But my expectation is yes, that people have used this as an opportunity both to continue their SIPs, but also to add new lump sum allocations during this period. Yeah, at least that's what that's what my read of the data suggests. Yeah,
got it. So we usually talk about how to invest in, say, all the kinds of mutual funds and all that. But say if a person who is invested already, what are the signs where he should be exiting that mutual fund or like ETFs or anything? Say there's a person who is not seeing good returns over a good period of time, say 5 to 8 years, there are no returns or bad returns compared to the market in that fund. Apart from that, what all things he should be seeing, say a higher AUM or maybe something else?
This is very hard, right? So when you look at market regimes and shifts in market psychology, even the last couple of years, returns have been, absent, shall we say. Yeah. And if you go back, you'll always find periods of time which can extend from 1 year, 2 years, up to about 3, 4, 5 years even, where returns have been quite minimal. Someone who invested in, let's say, in the peak of the market in 2007, even in 2012 or 13, would barely have seen any returns for that entire period of 5, 6, 7 years. What would your reaction be at that stage, right? And one very interesting thing is that the markets are not going to wait for you. You used a phrase, buying the dip, and some investors think that I can hold cash to buy the dip. And what happens is that if you say that there's a index or a stock or a fund or whatever it is, and the price today is 10 rupees, and I'll say, should I wait? I'll wait for it to become 8 before I buy. Before you know it, it becomes 12, becomes 15, becomes 18, becomes 20, and you're sitting there, and then one day there's a correction, and that the 20 becomes 18, and you say, oh wow, now I got a great opportunity, 10% down, I'll buy. But you miss that entire move from 10 to 18, right?
Yeah.
So the question is that how much of punt do you really want to take on the waiting for the dip? Because will you get the dip? Will you invest when the dip actually happens? When this war started, and at the bottom of the market in March, the worries were very different from where we are sitting today.
Yeah.
Right. The worries that how much of escalation can happen, and can the market fall more. Same is the case that happened during COVID or during global financial crisis. That can things get worse? During global financial crisis, mid-caps fell about 75%, give or take. And large caps fell about 50%, give or take. Now, what does that mean? Large caps halved, right? Mid-caps halved, and then halved again from there.
Yeah.
Now, imagine if your asset class is down 50, 75%, will you buy? Or will you say, if it's falling this much, how much more is in front of you? So that point of these situations where if you try to time the market or say that, my past return as in 2009 was absolutely poor. Over any period of time, 1 year, 2 year, 3 year, 5 year, even 10 year returns as of 2009, 10 years, in March 2009, the previous 10 year returns, right, was higher in bonds than in equities. 10 years. If you had just invested saying that, I wish I just bought fixed income and I just bought a bond fund and sat there, I would have made, of course you would have made the same return from 1999 to 2009. But post that, you've had a fantastic equity market, right?
Yeah.
So what is that time frame where you think that I have to exit? I think it's a very, very tough, and I think it is not the right approach. You have to have a plan, and you have to say that, what is my holding period? So let's say, for example, young investors who are in their 20s today, start of the career, right? Just starting to make some income, some savings, and therefore making some investment decisions. They're investing for a future which is still when they're in their 50s and 60s and beyond, right? So they've got a horizon of not 5 years and 10 years, but rather they've got a horizon of 20, 30, maybe 40 years or more.
Correct.
Right? Can you really extrapolate the last 5 years and say that same returns is going to happen for the next 40 years?
That's tough.
It's very tough. So one thing is you don't want to make investment decisions basis the recent experience. And I'm telling you from a perch of someone who's seen markets for more than 25 years, that would I have known 25 years ago that where the markets would be? No way. So one thing is, let's not extend any reasonable, recent period to future, too much into the future. Now, having said that, you still need to have a strategy. So, for example, you say, I want X% of my money in equities and X% in other asset classes, commodities, maybe fixed income, and so on. Okay, now you have a very large equity market move, which means now equity has become a much higher percentage of your portfolio. Maybe an opportunity to trim, reallocate. Similarly, if markets don't perform for a long period of time, you may want to add so that you bring your balance back into your portfolio. Suppose your original idea was to have 60% of your money in equity.
Okay.
Because of equity underperformance, that 60 may have become 55. Isn't that an opportunity to buy 5% more? Yeah. That's the way to look at it. I think underperformance, you do have the ability to play underperformance, but not in the way you think. It may actually, like I said in the example of 2009, the 10-year returns were very poor, but that was the right time to buy. That's, at least the way I see it is that I can't extrapolate, and I would say that have a investment plan, have some idea of what is your target equity allocation or fixed income, whatever asset classes you're playing. The other asset classes are not as volatile, but as equities is where you do see these swings, and it's not about timing of the market, but it is that how do you use market cycles to your advantage to rebalance your portfolio.
So my question was, say if someone is there for last 10 years, he's in the markets, and even if he's not seeing returns in his fund, market has given returns. Yeah. So how can he identify that fund itself is wrong? That's
a very good question. And here again, you look at, for example, market regimes and changes in market styles and factors. So again, using the recent past, last 10 or 15 years as an example, right? Post global financial crisis, I'm going to use ScanX because ScanX conveniently shows some round numbers in this period of time. At the bottom, we were at about 10,000 on the ScanX. Right, little under, but let's say you round it off that somewhere around 10K on the ScanX. There was a sharp bounce back, and if you were looking at the markets in 2012 with the previous few years in mind, the market had roughly doubled. And most of the return came in 2009 itself, But market went up from 10K to about 20K in second half of 2012. You would have been at about 20K. This was a period of time. It was a bounce back from GFC. The economic cycle still hadn't slowed down. It has started to slow down in India, but it was still, the economy was still doing very well. The second period is 2013 to 2018 is very interesting because you had a regime of sort of crisis after crisis. You had bank NPA cycle, taper tantrum, NBFC crisis, demonetization, lots of economic shocks, mostly Indian domestic economic shocks, right? And this is a regime in which sort of high quality growth companies did really well. But those who had troubles on balance sheet, for example, either because of the NPA cycle, etc., NBFCs, whoever had trouble in cash flows, whoever had trouble in their balance sheets, struggled. So broad markets didn't do all that well, but growth companies which were able to show strong, consistent growth, high quality growth, did exceptionally well. Now, what happened in the markets? Market again doubled between 2012 2018. Again, so the first doubling was post the GFC. Then 20K became 40K. And then you have reached another regime, which is post-COVID, where again you have had shocks, but most of these shocks are geopolitical or external to India. It is not Indian specific. So you had COVID, the current Gulf War, you had Russian invasion of Ukraine, and so a lot of shocks came from outside, right? This brought new shocks. This brought supply chain worries. This brought commodity prices going up, etc. The old regime didn't work. But again, what happened? Index doubled. So in that same period of time, again, 40K became 80K. So the market, if you look at it and then at any point of time and then say, okay, what worked in 2012, 2018 was high quality, high growth companies. What worked after that was a lot of the companies which didn't work in the previous cycle suddenly started showing growth, meaning because supply chains went up, commodity prices went up, China plus one. So basically people are trying to onshore production, etc. Right? So the old economy of sorts, which didn't perform in the previous cycle, started showing EPS growth, started showing strong growth, in fact. Growth from so-called value companies in terms of earnings growth in so-called value companies were showing almost as much earnings growth as so-called growth companies. And both were giving 20% growth in earnings. But the value companies were much cheaper. So therefore, value stocks did really well. Right? Value stocks in India don't do well because they're value, but value stocks in India do well when they show growth. Why I'm bringing all of this is that if you look at the last 10 odd years, is that you've had this regime change where market shifts from growth to value. Tomorrow it will be sector specific, capitalization, small caps outperform, large caps outperform, etc., etc. And very often, one, it is impossible to tell which is likely to outperform, right? Unless you're on top of the markets every day, it's impossible to tell. Two, even in all of these situations, on the whole, markets have done about the same. Meaning, like I said, markets doubled in a period where we had a lot of India-specific problems, and markets doubled when you had geopolitical problems also.
Yeah.
So, did it really matter? Yes, plus minus would have made a difference. How you can use this to your advantage? One, you should not back an entire portfolio in any one style. So, if you've got an allocation, have an allocation towards, let's say, growth as a style, value as a style. Have an allocation towards large cap versus mid cap, small cap. You could even buy index funds to just get a broad market proxy, right? To get a market exposure, while you use other active funds to give you the kind of additional exposure to those segments of the market which potentially have excess return. So there are multiple ways you can use these cycles to your advantage. It's not that the same style will work in all market conditions. Very often you cannot predict, but very often you may not even need to predict. Right? The broad market does well along with economy. So stay invested in broad market, diversified funds. And if you really want style, add some growth, some value, etc., something like that, to just give a little bit of edge to your portfolio.
And for that also, I feel you have to be invested for at least 10 years to see all these cycles happen.
I think 5, 7, 10 years at a minimum to see markets, right? Because when you've seen, like I said, 5 years, 7 years where market return has been practically zero.
Yeah.
It doesn't tell you anything about the future. I cannot make a very broad statement like that. It just tells you that what, for example, in the last 2 years is reflecting the market is flat over the last 2 years. Just reflects the fact that we've gone through a very difficult period of economic consolidation. Does it mean that we're going to be having economic growth consolidation forever? No, I don't think so. I think the cycle will turn and therefore the markets will do well. But we need to be prepared for periods of 1, 2, 3, 5 years where returns are what we think are suboptimal. But you remember a very, very famous statement that price is what you pay, value is what you get. Right? And this is exceedingly important, right? Because when price is correct, stock price is correct, that means there's more value left on the table for you. Assuming that underlying value of those stocks or the sectors or the fund that you are investing in has not changed. If there's a correction, or if the prices don't move for years on end, but the earnings are compounding. So say if earnings are going up at 10% per annum, but the stock price is exactly the same. Today is better value than it was 2 years ago. So the question that you have to be asking is that, is there value left on the table for me today better than it was when the prices were 10% higher or 20% higher?
So my next question is, do mutual fund managers also have targets? Say I have to achieve this much XIRR in the next 10 years, something like that. If yes, then how do you guys plan to achieve it? How does that happen?
It doesn't work at a fund level, but there are targets at a stock level.
Okay.
Right. So fund managers have to, when they're making an investment decision at it's a stock by stock decision. And there is an earnings model which we make. There's an analyst team which is doing that to each stock that is in our coverage. Today we have more than 450 stocks under coverage. So it means for 450 stocks, we have some kind of an earnings model, which we update, let's say every quarter when the results come in and so on, right? So there is an updated model which tells you roughly what the analyst thinks is the fair value or the intrinsic value or the potential target price of the company. So this will change as time goes by, but you'll have an idea. So every time the fund manager is making an investment decision, they are looking at today's price versus what the expected future returns is. So it's not about, there's a target price at a fund level or something, right? It's more that if each stock performs the way it's supposed to, in the sense of where we think there's intrinsic value, then you make a certain exit return, right? But that's a result. That's not the target. Now, obviously, the market's not going to play fair. The market's not going to give you the returns the way you want it to, right? So there is going to be deviations. So what happens if the prices go up a lot, and such that the price of the stock has gone above what we think is fair value? Then the question is, okay, either the thesis is very strong. Maybe we need to be looking at the potential and then saying that, okay, is our target price too low? Maybe the target price should be revised higher. Or we should sell, meaning we already achieved a target.
Yeah.
So that is the way you look at it. That you say, okay, I've achieved my target at a stock level. I should exit this today. Maybe I come back in if there's a correction or if there is future earnings upgrades or something like that, which causes me to come back in, right? Similarly, the price falls. That means upside is more. Yeah. Assuming my original thesis is right, the upside is more, which means I should buy more. But if the price is falling because that thesis has changed, maybe the growth in that company is weaker than expected, or sector dynamics have changed, or something else has changed, then you have to exit. So the idea of a research-led process is that you have at all points of time sort of an anchor, which tells you, it doesn't tell you that the price has to be so many rupees and so many paisa. That is not possible to determine because there is no exact price for anything. But it tells you what is the expected upside at any point of time. Or if there is any, sometimes it's expected downside. So if there is expected upside, what is expected upside? And then if you have 400 stocks, well, you've got, let's say, 100 odd large cap companies, right? You're a large cap fund. If you're a multi-cap or a flexi-cap fund, then you have 400 companies to pick from. But out of the four, you can't buy all 400 companies. So you say, okay, if I need to build a portfolio of 50, 60, 70, 80 stocks, whatever that number is, then I need to pick from this 400, which potentially will be the best performance. That's where portfolio management really comes in terms of being able to allocate how much weight I should give to each of these ideas. Am I getting sufficient diversification? I don't want to buy everything in the same sector. One sector may be looking very strong, but that doesn't mean you buy everything in only one sector, right? So all of those things come in. That's where fund managers come in and analysts come in. So these two need to work in sync for good delivery.
Say you are managing a fund and it crosses 1 lakh crore in AUM. Right. Does it get tough for you to generate the same kind of returns with a bigger AUM?
Not in most of the categories because our markets are pretty large and pretty deep. We have among the deepest capital markets in the world. At any point of time, there are over 1,000 stocks which we consider as really investable from an institutional perspective. Like I said, we cover about 450. So we cover about half of the stocks which we think are overall investable. With that kind of breadth of stocks availability and depth of availability, Indian markets, I think, are big enough to take decent amount of size. Now, is 1 lakh crore the threshold at which that size becomes too much, or is it 1.5, or is it 2 lakhs, etc.? I think as time goes by and the market expands, there is a little bit of expansion. If you had asked me this question 10, 15 years ago, I would have said maybe 20,000, 30,000. Things are getting more difficult. Today, we have many funds. We have funds in surprisingly in mid-caps and small caps which have reached many tens of thousands of crores, successfully churning their portfolios, minimal impact. So today, our markets are deep enough to absorb that kind of sizes. So yes, I think we have we have not yet reached the point where it is not possible to manage large fund sizes. But yes, the other question is equally important, that in certain categories, for example, in large cap funds, right, that's where you have the maximum breadth and depth available in terms of the type of stocks, the availability, depth, liquidity, etc. But that's also a category where the overall expected alpha has decreased over time.
So do you think alpha opportunities are shrinking?
In large caps, they have reduced over time. It is not that it's not there, but there the available alpha has certainly decreased over time, and therefore you have to use other means to extract alpha than just relying on these kind of short term. Let's say when I see short term, let's say 1 to 2 years, it's not enough to make large alpha. You have to take either more meaningful differentiated bets over, let's say, 2 year, 3 year or longer, which then means that you deviate from the index sufficiently with a medium term objective. So you ignore the short term fluctuation, don't worry about your 1 year returns, focus more on longer term. That gives you an edge, because not everybody in the market is focused on longer term, they're focused on shorter terms. That gives you a bit of an edge. And as I said, you have to take deviations from the benchmark. If you're going to just buy the same stocks in the benchmark, how do you outperform? Or if you buy the same stocks in the same weights as the benchmark, how do you outperform? So you have to take calls which are at substantial deviation to the benchmark, so that the ideas that you have reflect better, right? The simple philosophy in this is very simple. Like if you buy a stock, typically that means you expect it to go up, right? If I buy 1% of the fund in that stock, and that fund is, let's say, 2% in the benchmark, and if my idea is right and the stock goes up, then I get the benefit of 1% weight, but the benchmark is getting 2% weight. So what happens? Actually underperform.
Yeah.
Right? So the thing is that if you like a stock, not only should you buy it, but you should buy more than what is there in the benchmark. If the benchmark weight is 2, I must buy more than 2. But is 2.1, 2.2 enough? Not enough. To really make an impact on your portfolio, you should be that much more, maybe 3 or 4% of that stock in your benchmark, so against the benchmark, so that you can show that performance, right? So these two things need to come together. One, you have to have a differentiated way of investing, take a little longer view, and be able to take a lot of risk against the benchmark. Then you can start to show differentiation.
So in index fund, the weightage is as equal as Nifty, or it's...
The index funds, by definition, you're buying exactly the same weights as the benchmark, right? So index funds by definition cannot outperform. But index funds therefore also in many ways cannot underperform. I mean, they do. Yeah. So that sense, for many investors, taking a directional view just on markets as a whole, index funds is a perfectly easy way to do that. If you don't want to buy a large cap fund. But I think large cap managers really have to work much harder to deliver that alpha, because if you look at mid caps and small caps, you have an ability to discover new ideas, new sectors, new ideas which come up, new sectors and new themes which emerge. And smaller positions in mid caps and small caps already give you differentiation with respect to the benchmark or to an index, right? Whereas in large cap, top 50, top 100, everybody knows what those stocks are. It is not about discovery of ideas. It's more about, are you backing your ideas more and taking a slightly differentiated way of approaching those themes or the sectors that you're playing, so that you end up with a differentiated return. That is the two approaches. And you have to take a different type of risk in your large cap, which is more conviction, more longer term. Whereas in your mid cap and small cap, it's about stock discovery. It's about bottom up, identifying stocks and sectors which are likely to work for you.
So we talked about generating alpha. Do you think the sector rotation can be one key point where we can generate alpha from that?
Absolutely. There are two sources of performance of any stock, right? One which is the sector specific factors, and one is the stock specific factors. And you find this across either by sector or by theme. For example, a theme could be like, all of manufacturing tends to do well when manufacturing as a sector idea that does well. But it could be sectors, right? So, for example, within manufacturing, you have auto versus maybe defense or certain industrials and so on and so forth, right? So, one is to being able to identify the sectors. And then the second question is, can you identify the stocks in the sectors that you want to buy, right? So these two things I think are very important, right? That you need to take a top-down view on the sectors that you want to run and the themes that you want to run. And then what stocks bottom up that you want to buy in that. I think that's also very extremely important. I mean, in the last couple of years, we've seen in some sense a kind of a manufacturing revival where we've seen, and obviously led by the government in terms of defense spending. So we've seen defense do well. The PLI scheme for electronic manufacturing. So you've seen many of these sectors do really well from a fundamental perspective. In the stock market perspective, some of them ran up a lot, then corrected a lot, and then going up again. So those cycles you will play from an allocation perspective. But the thing is that, can you identify these larger moves in demand or policy, and then how do you play that top down by allocating across these sectors? Financials have done exceptionally well last year.
Metals also, I think.
Metals. So there are many places where you see this top down thematically working, and then within that, do you play what part you play? You could use, let's say, an index or a thematic approach to do this. You can just buy an index fund or a sector index fund or a thematic fund to do this as an individual. But very often, as fund managers, we do the same thing. We are making those same kind of calls in terms of the sectors and the stocks. Now, sector rotation as an idea itself is something which comes from that. That means, can we sharpen the approach so that we identify just, exactly these are the number of sectors that we are going to own, or these are the specific sectors we are going to own for now, but not by all the members of the index or all the members of that particular index, but all the sector, and just buy what the stocks that we like from that. So mix of both top down as well as bottom up approach. So that's one way of doing it. Investors, as you can do this. It's very, at one level you can just buy sector funds, thematic funds, and do it yourself. But then you're spending a lot of time trying to analyze each of those sectors. These two things do change from time to time very quickly. Second is that there is a churn and tax implication when we churn portfolios, right? As individuals. But the fund is tax exempt. So therefore, if you stay invested in a fund, the sectors in the fund may have rotated 3 or 4 times by the time you redeem. But from a tax perspective, it's much more efficient to have a lot of this churn happen in a fund rather than to have to do it yourself. Yeah. So these things you need to keep into account when you're making a decision. Do you want to do it yourself? Do you want to do it in a fund? Do you want to use index funds? Do you want to do active? There is a space for both, but I think this is the way we approach.
When you invest in a specific, say, sector, say pharma or FMCG, how long do you wait to see, okay, there's some momentum building up or something like that? Like, what is that time period?
So there is no one answer to this, right? There are some tactical where you want to play that theme for a period of maybe 12 months or 24 months, etc. And these are reasonably short cycles. But for sectors like consumer goods, FMCG, etc., they may be fast moving in their nature, but the reality is that theme there plays over many years. That when the economic cycle turns, right, then consumer spending typically goes on for many years, and the stocks also tend to do well over a cycle. Maybe this could be 3 years, 5 years. And when the slowdown happens, similarly, these stocks tend to underperform for a longer period of time. So the way that you play the cycle, for example, in metals or any other commodity, is going to be much shorter compared to something which is much more broader, which is like a consumer sector where you can play this over a period of time. Automobiles, again, it's a longer cycle. CV cycles are long, passengers even longer. So when you look at the cyclicality, these are cyclical, but they are not the same cyclical that you expect to see in a commodities or in capital goods or something, where the cycles could be much shorter. Not always, but there's no one answer to that question as to, do you have a time? Yeah, you do have a time frame in mind, but that time frame is quite variable.
Say you have a fund, and how much cash does that fund have usually, say, at this moment?
Usually the cash is there only to facilitate exits and entries. Meaning when you sell a stock and you buy a stock, there will be cash in the fund, right? Similarly, when there's investor inflow into that fund, there's a bit of cash in the fund until it's deployed. We don't target cash. So we just work, because at the end of the day, the volatility of the fund or the performance of the fund, it depends on what you own, not what you did not own. So in that sense, the cash is what you did not own, right? So it's, while it does at the margin affect your, day-to-day volatility or something like that, it doesn't really shape the performance of that fund. It's the stocks that you own, the weights of the stocks that you own, that actually determines what that fund is about. So we really don't target that we need to hold cash. Now, I know that that's a different approach from what some funds do in terms of being able to taking active cash calls. But we believe we can do that in other products. There are products like balance advantage funds, multi-asset funds, etc., where we are we are actually doing asset allocation there. So we are actually taking calls on, let's say, in a balance advantage fund or an equity savings fund, how much equity should be there. So that is where you take those calls in terms of where, and that therefore it's transparent to the investor. An investor who comes into a balance advantage fund knows that at all points of time they will not have the same equity. Or comes into an equity savings fund knows that there is a range, but there is a range, and that the non-equity component will be there at all points of time. But if you have an equity fund, the investor comes expecting equity returns, and then the fund manager decides, I don't like equities, then there is a disconnect.
Yeah.
So it is. It's not something we are very comfortable with to have cash in the fund. Like I said, it is largely there to facilitate transactions. If I have a 3% or a 5% position in the fund which I'm exiting, until I buy the new stocks, there could be 3%, 5%. The stocks have been sold, cash is there, new stocks haven't yet been bought. There's that much of cash, but that is transitory, and it's not because of the need to hold cash, right? So that much amount of cash which facilitates entries and exits. We may keep cash because in anticipation that I am looking to deploy into a stock, or I'm looking to deploy in an IPO, or whatever it is, right? There's a need to hold some cash, but that's about it.
So do you think that maybe having some cash might help you in, say, some correction when it happens in the market?
Again, going back to the example of balance advantage funds like that, yes, there we take that kind of active call, right? So there, holding that cash or the non-equity component definitely makes a difference in terms of buying when we believe there's value. In the more diversified funds, you don't use cash to do that. You can use your stock level allocations. So for example, if you believe that markets are overvalued or there is a correction that you're concerned about, can you find stocks which will do well during market corrections? Can you find stocks which are resilient during market corrections? And similarly, if the markets if there is a sort of expected upcycle, right? Can you find stocks or sectors, or even if you're going from if you have a flexi cap, going from large cap to mid cap or small cap, if you expect upcycle in the economy, that's another way of expressing this. I think those are much more, in a sense, within an equity context, the right approach, rather than to take a call and say, this money is equity, but I'm not going to invest in equity. Because that is a decision for the investor also to make, right? The investor has said that I am allocating money to equity. And is it the right thing for a fund manager to say, I've taken money for equity, but I'm not going to do it? So I think there is that disconnect which I'm sort of uncomfortable with. We are very happy to do it in the hybrid funds where we take that kind of allocation decisions. I think that's where we're happy to have.
So when you pick a stock for, say, any type of fund, small cap, mid cap, even large cap, what is the key metric you look out for? Is it valuation mainly or something else?
Growth first. Okay, India is a growth market. There is nothing value about India. The value index in India trades at 18 to 20 times most of the time. There is, if you look at even today, you look at the world, you can find many stock markets, and pretty large stock markets, where it's still trading at single digit PE. Not value stocks in those markets. Market level. You go back about less than 2 years ago, the entire Chinese market was trading at 9 times. Right? That is value, right? When you have single digit PE at the market level, or there are stocks which are trading at, 2 times, 3 times, 5 times, things. There are stocks which are, that's value. India is not value, right? So its first thing is Indian markets have always rewarded growth. But does that mean you buy growth at any price? Right? Because you need to keep valuation in mind, because if you overpay for that growth, then the growth may come, but your stock price will not react. For example, if the stock is already discounted next 5 years worth of growth, where is the joy? Yes, it will deliver the growth, but it's not going to deliver returns to you. So this balancing of growth and valuation is extremely important, but growth first. If the stock is not expected to deliver growth, the valuation will never respond. So, and nothing's cheap that I can count on value. There is this intrinsic value approach that we take, right? So for example, you say that, okay, there is a certain stock which is trading at a certain PE or a price to book. Now, earnings compounds at, say, a certain rate, maybe 10%, 15% per annum. So therefore, you expect that the price, the value, if it were to trade at a certain PE, will also compound at that same rate. Now, for an example, if that earnings growth was, let's say, 50% per annum for the next 3 years, 5 years, extreme strong growth companies. Today, even if you overpay for that stock by 50% over what you think is fair value, within 1 year, the fair value catches up, right? Because E is growing so strongly, and then you may miss a year's move, but the next 2-3 years, you will catch it, right? So that is a kind of a growth at any price approach. You buy, even if you buy at a premium, the earnings are so strong that you catch up. The other approach is pure value, where you don't expect really any kind of growth. Therefore, the PE ratio will remain stable or ideally. And therefore, you say, okay, if I buy the stock cheap, then I'll catch up to fair value. If I buy it at cheap PE multiples, it'll go back to normal PE multiples. I'll catch up to fair value. Because there is no unexpected growth, right? It's stable business. This is a two opposite approach. There's pure growth approach and there's pure value approach. But Indian markets, I think, are in between, where you have to focus on growth. This is a high growth market, but you cannot pay any price to get that, to catch that growth.
Yeah.
You have to be mindful, and you don't mind paying a small premium to enter that growth, but you should be very mindful that you're not overpaying such that years worth of growth is eaten away by the premium you paid. So it's a little bit of a balance. It is valuation sensitive, not value sensitive. Meaning, there's no, like I said, in India there is nothing called value. But growth first, valuation next.
When you talk about the growth story, which are the few sectors which comes into your mind very instantly? Okay, these are the sectors which can do good in the.
We've had in the current context, almost all the ideas are sitting in manufacturing sector. To some extent in financials. Obviously, we have had sectors like IT which are languishing in terms of their ability to generate growth. So certain services businesses are struggling in that sense. Consumer goods have struggled for the last couple of years, and therefore there are challenges. But if you look at manufacturing, if you look at financials, you look at our own business, asset management and capital markets, they've done exceptionally well. So I think there are strong pockets of growth in many of these. But you need to be very careful. Just in the last couple of years, we have seen so much of volatility, especially in manufacturing. Let's say created by the tariff situation last year, right? If you look at the stocks in manufacturing, they did very well in 24, did quite badly in most of 25, and then have had again a resurgence of late. And a lot of that is due to the tariffs. Now, so we have to be sensitive about what factors are driving it. Some are coming from outside, unexpectedly coming from outside sometimes, right? Just a little aside, but I think it's important to understand in this context is that we often look at the exports as a percentage of GDP, which is quite low for India. We look at the tariffs impact as a percentage of GDP, which is quite low for India, and then say that there's no major impact of the US tariffs on Indian economy. And absolutely right. But what is left unsaid is that manufacturing as a percentage of GDP in India is also very low. Therefore, manufacturing exports as a percentage of GDP, manufacturing GDP is quite material. So, in that sense, the impact on the export business, which happened in 25, was quite material from a business perspective. So thankfully, those risks are now behind you. You are seeing government spending money on defense. That's a structural story. You are seeing capex. You are seeing a lot of these export sensitives coming back. So across the board, we are seeing that manufacturing play in many, many places. The very interesting thing is that most of these companies are not in your large cap indices because manufacturing as a whole sits in mid-cap and small cap. So thematically, actually, it's interesting that if you want to play manufacturing, one way to do that is actually to buy a small cap fund or a mid-cap fund because that gives you that exposure. The second theme which has worked reasonably well from a stock market perspective last year was financials, capital market included, but also banks and other entities. The economic cycle is, in my opinion, is turning up, and financials will do well. Financials will do well if interest rates go up. A lot of people think that rate cuts help financials, but actually rate hikes help financials. So if the RBI embarks on a rate hike cycle, because they themselves are expecting 4.5% plus inflation, right, 1 year out. So if inflation goes closer to 5% mark, and the RBI starts raising rates, I think financials will start doing well. And so I think theme for us are across a few of these spots where we think there is that's today. Things will change. We must be also mindful of the fact that many of these manufacturing sectors, stocks, etc., are very expensive. So it's not that markets are not already recognizing this growth and is playing. So you still have to balance. Yes, you're macro positive, but you still have to balance that growth versus valuation trade-off, even in this situation. Yeah.
So your thought on very small growth stories like say e-commerce or quick commerce, EV maybe, thoughts on these?
They're, I think, structural stories. The transition from fossil fuels to electrification is going to be everywhere, including in auto. We are also seeing that play out in terms of the capex and the power sector, right? So there's more investment in grid, there's more investments in new generation. So whether that's in the EV stroke electrification play is, I think, a structural story which is playing out in many parts, whether not just in auto, but also
even recycling also, I feel.
Oh, yes, actually, yes. So that's I think a medium term to long term structural play that you look at. Again, be mindful of value, how much you're paying for those that growth story. So that's something is definitely something which we like. Now, when you come to other things like quick commerce, etc., we've seen a lot of volatility. We've seen great successes, but we've also seen volatility because these business models are not always proven, right? In certain cases, they will take time. There will be consolidation, and therefore it's a theme we really like. But we are mindful of the fact that there could be a lot of consolidation going forward. We do think that consolidation will be beneficial, and so that thematically it's something we like. But how you invest, which stocks you buy, is something that's so overall. It's not just about quick commerce. I think platforms in general, there is a great story in terms of it could be, we've seen again in financials, we've seen platforms, including your own, they are seeing very, very strong growth. We've seen growth in almost every sector. You are seeing opportunity for platforms or two-sided markets in some sense, bringing together customers and manufacturers or service providers. And there's, I think, very, very strong growth. And so that's a theme which we really like. It's a core theme which we are playing in our innovation fund, the whole idea of platforms. That's working really well. So I would say that quick commerce and many of these are kind of subset of platforms. In our ability to play that.
We talked about innovation fund. So can you talk more about it, thoda?
No, so it's basically a fund which is looking at these kind of new ideas, new business opportunities. Today, there is a bias towards some of these platform kind of ideas in that. So I think there is an opportunity for us to look at the entire ecosystems which are getting developed today in many parts of the economy, and trying to identify who are likely to win, where there is likely to be consolidation and therefore money to be made. Some of these, quite a few of these, not necessarily profitable today, but the business models are getting established. Many of them have become profitable, are becoming profitable. And I think that is again a medium-term play. There is consolidation. There are new markets getting established. And therefore, I think platforms will work. And there's whether that is in, e-commerce type of platforms, whether that is in financial platforms. And tomorrow could be, I think, you're seeing in some sense, two-sided markets and platforms getting developed even in sort of old economy type of places. So that also, I think, I will do.
So we'll go with the last question. Inside a fund house, how often do investment teams disagree and how do you tackle that?
Every day. There's disagreements every day between fund managers, between analysts, between fund managers and analysts. Every day there's a disagreement. To put two people together, they'll disagree on everything from what is the underlying assumptions of an earnings model to what the eventual target price is. They're bound to disagree. But that is our market, isn't it? There is no one price. There is no one trade every day, right? Every day, every fund manager will have a different approach. The way that we have to do as a team, if there are 5 people sitting in a room with 5 different ideas, how do we agree? Right? There has to be some agreement, and then eventually there will be some disagreement also, but that is perfectly fine. But are we making investment decisions based on as much complete information that we can? Because everyone will come and say that I disagree. It's not that I disagree because I disagree because I have a certain point of view. It could be that your assumption on growth rests on some data point which I have a different view on, right? So people will bring arguments to say why they are right and why the other person is wrong. It is a rational, at the end of the day, it is a rational disagreement. It is not disagreement for the sake of. And I completely encourage that. My point of view is that we need the different ideas to come to the table. And the idea that stands at the end of that argument is probably a good idea. Even at the end of all of that, you still want some amount of disagreements to be expressed in the portfolios. So not all fund managers are going to buy the same stocks in the same proportion, right? Some fund managers will be more convinced and therefore will own more of it, right? One thing we don't do as a fund house is that we don't want people to take opposite ideas. So for example, if we are positive on stock X, it shouldn't be the case that one fund manager is selling, other one is buying. That creates dissonance.
Yeah.
But it could be the case that one fund manager doesn't buy because they have the same risk expressed through a different stock, or the sector is already there in the portfolio and they don't want to add a new stock, etc. Fine, you are allowed to have some amount of deviation in the portfolios. But we don't want cross views, right? Which is expressed in portfolios, right? So if two fund managers disagree, they still have to eventually come and convince each other and have one agreement. Okay, does this stock belong or not? And if if the analyst and the fund managers agree it's a sell, then it's a sell. Or if it's a buy, it's a buy. Okay, degrees of buying may be slightly different depending on every fund's mandate. A large cap fund, whether you like it or not, cannot buy a small cap stock, even if it's the greatest trade idea, right? So there will be differences in the portfolios. But yes, disagreements bound to happen and will happen. And the mark of, I think, a good functioning investment team is that you disagree, you actively disagree, and then when you come back out of that meeting, all of you are still in sync in terms of, okay, we've all done a good job for the fund, and that's really what matters.
I think there's some bias also, is there?
It's not bias in the sense of the way we understand bias. Bias comes from everybody's background. My own background is macro. So every investment decision I go to, I will look at it from a macro perspective first, right? I will look at it top down always, because that's where I've come from. I've come from a background where I'm much more interested in macro. I've done fixed income for a long time. So I have a bias to doing things top down rather than bottom up, right? There'll be people who have done bottom up all their lives. They just don't care about what macro situation is. Both are valid answers, right? There'll be people who have, let's say, spent a large part of their career as an analyst tracking maybe 3, 4, 5 sectors, right? They will understand those sectors and stocks more than they understand other sectors and stocks. So it's not that creates a bias, but it just brings out that they may be a lot more expressive about those sectors. When let's say an analyst comes and make a presentation about a particular stock in a sector that they may have covered till last year or the year before, then they may have a stronger point of view. So these things, I think, are important to also keep. Ensure that you're not bringing in all your analysts and fund managers with the same point of view. Then you just bring a monoculture of sorts, and if that idea is wrong, then everybody goes wrong at the same time. So the idea is to ensure that there is sufficient challenge process, that people who are fund managers have come with different backgrounds, or who have come looking at different sectors or different styles, so that there is a little bit of disagreement by design. But yeah, as long as we are all, the end result is we are all focused on trying to do the best for the portfolio, then we are fine.
Got it. Thank you so much for doing this. It was a very insightful session. And thank you so much for watching this video. If you guys have any feedback, do let us know in the comment section, and do subscribe to the channel. Thank you.
Investments in the securities market are subject to market risk. Read all the related documents carefully before investing.